been surprising, and I think it's very bullish globally, is financials have been one of the leadership groups for most of 2024, particularly the back half of 2024. The European financials look good. The Chinese financials look good. The Japanese financials look good. It's really, really hard for us to draw a link that this is going to be something that's more nefarious and deeper and longer when you have the support of the financials. And I know they're correcting, but when we look at relative performance, when we look at some of the other things that help us to discern where the leadership is, they're still very, very good. And importantly, they're good globally.
Jeff, let's bring in Mike Santoli, our senior markets commentator. He's sat down next to me to help us make sense of what's going on here. What do you think? I mean, we're a couple hundred points off the low, at least in the Dow, but the Nasdaq's still down 4%. Krinsky making the call that this is your chance. The graph, as you just hear,
sure.
You know, we're getting close.
Yeah, I mean, pretty much most of the things you'd want to see line up have done so, although I have to say there's always a few things that stand out. You could make the argument that treasuries as well as the VIX are kind of underreacting a little bit here to what we're seeing in equities. Part of that is that for much of the day, you had 1/3 of all stocks were up. There seemed like there were places to hide. There's been enough dispersion to kind of keep the indexes from going into free fall. Some of the action, though, in the last hour or so really did look forced. So you started to see the former kind of momentum favorites really get disorderly on the downside. Maybe that means people are getting cleaned out. So I think you're at that point, down 8-9% in 3 weeks in the S&P 500, where unless you're really expecting a near-term economic calamity of some sort, and you may always get some kind of fund blow up. We're really expecting a near-term in the capital markets that we just can't handicap right now. But that's just one of those. You don't bet on the black swan. You kind of put the probabilities in your favor. It feels like things are lining up for some kind of relief relatively soon. I know there's not a lot of, we didn't spend a lot of time in this particular area of the S&P last year. I know some of these downside targets have been hit. We're below the summertime highs. So some people are saying, oh, down 2% from here. That's the real one. I mean, you can't be that precise about these things. If your game is to try and put things, slightly in your favor tactically.
I mean, there are some on the street today, while, tactically negative for the near term, are still keeping their eye on the long-term ball, trying to see the forest through the trees.
Right.
The problem is when you have this type of scorched earth approach, the wrecking ball approach in some respects, like, Doge, for example, has done, things break.
Right.
Things get broken, and it's a little hard to pick the pieces up when they're shattered on the floor.
If you are a stock picker, it's very hard to see the circumstances under which in the next few weeks you're going to be raising earnings estimates for your companies, right? I mean, yes, something can happen on the one-off, and maybe the market has kind of discounted a little bit of softness, so you're okay there on the valuation. But it's just difficult to say that earnings where we expect them right now is actually going to be higher in a few months. That being said, again, the market moves faster than the fundamentals. So at some point, you get it to a position where short term, it looks like, hey, we're going to rally no matter what happens. It's kind of close your eyes and buy time at some point, as opposed to believing that therefore it's going to be all okay and we're going back to the highs.
Jeff, I got a lot of targets that are 1,000 points higher from here at minimum.
Look, we think the S&P closes somewhere around 6,800 on the year, and I'm comfortable with that. We went into the year seeing the biggest number of strategists raise their year-end price target that we'd ever seen in the history of our data, which is about 30 years old. And it just said to us, look, there's going to be a consolidation. It's probably going to be a decent year. That was about a 15% move from where we were. And we thought it'd be a much better year if we could buy an oversold condition in the first quarter, which we thought would happen. And so we're right in that zone. I think that can make for a really, really good year. One thing I would note, Scott, you look at Tesla today, the disaster that's happening in Tesla. Pull up the CDX charts, the credit default swaps. They're actually trading at the lowest lows in 3 years. So clearly there's some disconnect going on here. People are looking at the stock much differently than they're looking at the realities of the business. And I think there's a lot of that taking place.
All right. I appreciate your time, Jeff. Thanks very much. That's Jeff DeGraff, Renaissance Macro. Mike's going to be back with us, of course, too, as we approach the end of the day. The prospects of slowing growth and sticky inflation putting the Fed in a very tough spot, just as it was feeling pretty good about where things were heading from here. Let's welcome in Richard Clarida. He's the former Federal Reserve Vice Chairman, now Global Economic Advisor to PIMCO. It's good to see you. Thanks for coming on today.
Yeah, thanks for having me on.
What's the Fed thinking right now?
Well, I think the Fed has a lot of experience looking at very volatile markets. I don't think that anything has changed relative to what we heard from the chair on Friday. They think that they're in a good place. They think the economy entered the year strong, but the chair did correctly highlight there's a lot of uncertainty right now. Trade policy, tax policy, spending policy, immigration policy, and geopolitics are all quite uncertain. And so I think markets are reacting to that. But I don't think the Fed's fundamentally doing anything different than we heard on Friday from the chair.
What happens if the economy weakens like the market fears, but inflation is still above target and we still have unknowns relative to tariff policy? What does Chair Powell do?
I was looking intently to see if the chair on Friday would repeat what he has said at recent press conferences, which is that they would cut rates if the unemployment rate went up, if the labor market or the economy slowed sharply. So I take them at their word. I think that they have a dual mandate. Ideally, they would like to cut rates with inflation back all the way to target, but I think they've pretty consistently made the case that if we see a pronounced slowing in the economy and an elevation in the unemployment rate, that they'll begin to adjust rates lower, and I'd expect them to do so.
So you're essentially saying that the Fed put is alive and well?
Well, certainly, if you actually get a tangible weakening in the economy, I don't think that they would cut rates into a forecast of a weakening. I think they'd have to see it in the hard data. But yes, just based upon what the chair and others have said, I think if they see that in the hard data, given right now where we are in inflation, you know, Scott, on a 12-month basis, the inflation numbers are likely to continue to come down for the next several months. And so I think at least over this time frame through the first half of the year, if we do get that slowing, and let me say, I don't expect that. That's not my baseline. But in a scenario that you lay out, yes, I do think they would be cutting.
What role does this market upset play in their thinking?
Well, right now, you know, markets are still quite close to all-time highs. You know, if I were still back in my old seat, I'd be interpreting some of this in the stock market as perhaps, you know, a welcome adjustment to markets that maybe have been a bit frothy. And I think some of your previous guests were making similar points. You know, obviously markets can go up and go down, but when you're close to all-time highs and close to all-time highs in terms of valuation, I think right now to them it looks like more of a reversion to maybe somewhat more sensible levels. Again, profit outlook for the year, from what I understand, is pretty solid. So I think that they'd also be focusing on that.
I'm wondering what you think of what the Treasury Secretary told our network late last week, the idea that there's no Trump put. The market has assumed, I think investors have assumed, that if there's enough pain, that the president, as much as people want to believe he pays attention to every movement of the stock market, is going to take a little bit of the pressure off to avoid a deeper sell-off. How do you see that yourself?
Well, I certainly did take note of that statement. You know, the tricky thing for the secretary and for policymakers is sometimes markets go down because the economy is going south, and so I think in his case, as with Chair Powell, they'll be trying to disentangle a signal from noise. But I would defer to the secretary if he wants to say there is no Trump put.
What happens if they actually want the Fed to be put in a position where they have to cut rates? I don't think it's any shock to suggest that the president himself, because he said it himself, likes low rates. So what happens if they feel like they need to do this to force the Fed's hand?
Well, I think in that scenario, and again, I don't expect that, but I think in that scenario, they would not succeed. If it's not in the data, I don't think this is a Fed that is inclined, and I think we heard that message loud and clear from the chair on Friday in New York. This is a Fed that's certainly not inclined to cut rates based upon a forecast of weakness. You know, maybe a parallel here would be useful. Back when I was on the committee in 2019, you know, we had some tariffs, but we had a lot of trade policy uncertainty. Inflation fell by 0.5 point down to 1.5. The ISM fell to 46. I'm telling you, if inflation falls to 1.5 and the ISM's at 46, they'll probably be cutting. But I don't necessarily think that the forecast of that is going to get them off hold.
Mr. Claret, I'd like to bring in our Steve Leisman, our senior
Hi,
markets
Steve.
correspondent, of course, into the conversation. I'm not sure if Steve, you heard Rich says hello. It's good to welcome you. It sounds like Mr. Claret doesn't see near the level of maybe conundrum that some have pointed to of a Fed that has to make a choice between a weakening labor market but still elevated inflation. If the labor market weakens, Mr. Claret says Fed's cutting. Full stop. What do you think?
I'm going to pause anytime I think I have a disagreement with Richard, who's taught me more about monetary policy than maybe any other individual. But we might have a slight semantic difference, and it may have to do with timing. Scott, I'll give you an example. If you look at the Fed funds futures market, there's a very interesting change between the probability of a cut in May at 41%. It then doubles to June for 83%. It tells me the market is thinking about maybe the same thing I'm thinking about, which is the idea that the Fed has to wait to see what happens with tariffs and how they work in the system. So, for example, you get a month's worth of tariffs in the system. They're going to raise the price level. You might want to wait a month to see if, for example, non-tariff goods are also going up, if that trend that Richard talked about of lower inflation is still playing out and pulling down. I embrace the conundrum maybe just a bit more than Richard does, because I think the Fed would have a hard time saying, we are cutting interest rates on a month when the CPI index went up by half a point or whatever that number is going to be. I don't suspect that's a big difference with Richard. I think that what I've heard the Fed say is this idea that we're going to look at which of our mandates is deviating more from our target and be more likely to address that one. So a big drop in jobs and growth, yeah, the Fed addresses that. But if it's a closer call, the Fed would wait a little bit longer.
Rich, they don't say timing is everything for nothing.
Well, Steve, I think if you heard my entire comments earlier, you and I are on the same page. I'm not really getting into May versus June or July. What I did say is the Powell, I thought, made very clear on Friday in New York that they're in a good place. They don't have to react to a forecast on either variable, inflation or the labor market. What I did say earlier in response to a question is, if we see a tangible slowing in the hard economic data and a tangible rise in the unemployment rate, I think they will cut. And whether or not it's May, June, or July, I think we are in a mode where a forecast of a slowdown or a forecast of a pickup in inflation from tariffs is probably not going to get them off the dime. So I think it is going to have to start showing up in the hard data. And I think you framed it well. We're in dual mandate territory now where they may have to make a choice at some point. But again, I was struck at how firm the chair was on Friday in response to in the conversation with Anil Kashyap and in the opening remarks about the fact that if they think the labor market's in a good place, they wouldn't welcome softening in the labor market from here. So I think that's also going to be relevant.
But to be clear, Richard, but before Steve, you respond, to be clear, you suggest that if that takes place and they cut because there was a material and meaningful deterioration in the labor market, there was an uptick in the unemployment rate, while at the same time inflation remained above target, that they would not hesitate in your mind to cut.
Yeah, certainly along what we're looking at for the rest of this year. As I said, the 12-month numbers are going to be coming in pretty favorable, and it's going to take some time for the tariffs to pass through. And again, as we've all seen in the last couple of weeks, there are announcements and then there are deferrals, and so I think that's also going to be part of the assessment as well.
Steve?
Yeah, I'm not going to disagree with that. I just think there are some interesting things coming down that the Fed has to figure out. I think the tariffs are one thing. I'm very interested in this idea, Scott, that one of the targets of the Trump administration is federal spending. Federal spending is a circuit breaker that is typically there when the economy weakens. It's interesting this time around that it could be that federal spending is not only not a circuit breaker, but perhaps one of the causes of the weakness we see. So ultimately, that may prove Richard more than right in the sense that if the Fed sees that the federal government is not going to be there with a certain amount of spending, that it's causing some of the weakness, they may feel they have to come in and be the so-called only game in town to help the economy here. So we're just going to have to watch how much this sentiment issue, and I agree not only with Richard, but one of your earlier guests has said, the recession is not in the data right now. It's in the sentiment data. It's not in the hard data. And you want to take a little bit of, I don't know what you call it, a pause here in getting too concerned about it. This issue, though, that the Trump administration officials have said, we're not that concerned about what's happening in the market and that there will be some pain, causes you concern. And Scott, I keep thinking about what the people on Fast Money or the brokers out there are telling their worried clients today. What is their story that says this is all going to be okay? It's a very tough story to tell right now.
Yeah. And Richard, before I let you go, I guess this is a real-time look at why, when some have suggested that the Fed chair was pretty darn close, it certainly seemed like, to declaring victory over this fight against inflation, that he was just reticent to do so, because you just never know what's going to happen before inflation fully gets back to target. That jumpsuit's going to have to stay in the closet for a little longer.
Well, for sure. And again, as I said earlier, at least following your and other coverage, it looks like the earnings projections for the year are still quite solid. So some of what we're seeing is just changing those price earnings ratios. I think ultimately stocks are going to come down to the earnings trajectory. So
we'll leave it there. Mr. Claret, I can't thank you enough for your time today. Thank you. Steve, thanks for rushing to the camera for us, too. Good to add you to that conversation. Steve Leisman, Bob Pisani's just sat down at our desk here at Post 9. What's on your mind? What sticks out the most to you today?
Well, sure enough, 45 minutes ago, the VIX went into backwardation. And this is a really good short-term indicator. The VIX hit 29. That's a little more than one standard deviation above usual. And what happened is the VIX yield curve, the curve for the VIX, that is short-term options, the ones that came out in the immediate future, March and April, those options are trading at higher levels than those further out. That's called backwardation. In the past, that's a very unusual situation. And in the past, that is usually associated with short-term tradable bottoms. And I'm very specific on this. I say short-term, and Mike, you've talked about this, tradable bottoms, because ultimately we don't know where this is going. Once you start getting concerns about a slowing economy, or even the R word, the recession word, it is very difficult to call any bottom at all. So usually that kind of movement, when your VIX is in backwardation, is associated with a short-term tradable bottom. Sure enough, when that happened, the VIX started, the market started turning around a little bit.
That's the Krinsky and DeGraff calls.
Those are very traditional metrics.
Tradable bottom. If we're not there, we're getting close. One says we could be there. The other one, well, we're awfully close.
Yeah. The problem here is you can't call any real bottom, because if you actually are in a real economic slowdown, we don't know. You just heard from Steve. We don't know if we are or not. If we actually are, there are multiple legs down that happen in that, and particularly when the analysts start lowering their estimates. As we all know, the analysts are slower. The market moves ahead of the analysts. The analysts, at some point, if they believe there really is an economic slowdown and they're hearing it from the CEOs, they'll start lowering the earnings estimates, and then you'll have another leg down. We don't know if that is actually happening yet.
We went from a situation where the economic surprises rolled over. The market ignored it, right? That was happening for weeks. And so now I think we're almost swapped places, where the market, if you look at it from an index level, perhaps is exaggerating the near-term or expected weakness in the economy, whereas before it was ignoring it. I was looking at the industrial sector earlier, XLI. It actually peaked and started falling well before the S&P 500 did. In the last couple of days, it's been outperforming. It went down as much as the S&P, but the S&P is now caught down to it. The point is, we've had this kind of rolling situation for a while, and you have to be open to the idea that just as in the last 2 years, January and February data were super hot and made everybody think the economy was racing ahead of us. Now you got Jan, Feb a little bit soft. You just don't know to what degree you can extrapolate that. So more open-mindedness than making a call that the market has it wrong here. But I do think that this complete purge in the mega cap and related AI and momentum names has been this massive exacerbating factor that isn't really about macro. It really isn't. It's mostly about kind of positioning. It's about the crowding of the market, and it's initial conditions.
Yeah.
We started out with an expensive, highly concentrated market. this is the way the market's dealing with it.
The market for sure is pricing in more than just tariffs here. I mean, in a worst case scenario, we've been passing around these numbers for a month now. Full implementation of massive amounts of tariffs. You're talking about 6, 7, 8% reduction in earnings. That's very significant. But the S&P is already down today 9% from its recent high. It's already pricing in like maximum tariffs, and we don't even know if that's going to happen. Of course, the president could change that at any moment. This is what makes people a little crazy every day.
I mean, the market was already sort of screaming to you, defensive. It's a more defensive tone. Healthcare and staples. If you're wondering why, especially healthcare, woke up, in large part it was because people started to get a little more defensive before the worst of what we were seeing on the screens over the last few days started taking place.
They haven't been selling the defensives. Like, look, Kimberly-Clark new high today. Some of a lot of various consumer stocks were hitting new highs. So those are holding up. The consumer staples sector today is close to an historic high. So in a sense, Mike, you could argue this isn't the bottom because they'd be selling those if this was really a
if
serious,
it was a real
actual
desperate get me out at any cost. Yes, for sure. But also the cyclical trade has just left the country. The cyclical trade is in Germany. It's in the rest of Europe. It's in Asia. So it's not as if everything is completely synced up globally in terms of where we are, at least perceived where we are on the site.
All right. Mike, you stay. Bob, thank you for rushing up here. Appreciate you. Let's talk more about the financials getting hit hard yet again today. Leslie Picker follows that money for us here at CNBC and joins us now. Just when you thought maybe it was going to stop, it hasn't.
Yeah, no, Scott, great point. It's just another rough day for the financials. The banks specifically, you look at Morgan Stanley down nearly 7%, Wells Fargo down 7%, Goldman down 5%, Citi down 5%, JP Morgan, Bank of America also getting hit hard. Now, you all were talking about kind of the impact on analyst revisions and when we might start to see those relative to, expectations for the economy. Well, the banking sector is a perfect example of this. And Wells Fargo analyst Mike Mayo has a perfect summation for how this downward bias actually does have an impact into near-term earnings. The first, he says, is that policy uncertainty can delay lending and capital markets acceleration. This is this idea that if there's uncertainty about how things play out in Washington, that may kind of create this chilling effect over doing big M&A and IPOs as well as big financing deals. Second, he says that the expectation of a greater chance of recession can lead to reserve bills. That has a direct impact on earnings as well. And the third thing he notes is a lower forward curve can reduce the degree of benefit from fixed asset repricing. This plays a role in a couple of companies, namely Bank of America, which was set to really benefit from that. So in those three ways, the market activity as well as the psychology is having a direct role potentially to the earnings. I mean, obviously, it's still kind of midway through the quarter, but just something to note as we think about the overall psychology and how it plays a real role in the accounting here.
Unbelievable moves, Leslie, in private equity names over the last month.
Yes.
Trading like high valuation growth stocks. I mean, down is KKR 27% over that period of time. Ares is down 26%. The losses today alone, yet again, are just startling to look at. You just don't see stocks like this trade like that very often.
It's exactly right, Scott. A lot of these firms have a portfolio of kind of private equity buyout type companies. They are aging, and there's some question marks surrounding whether they've actually took the marks that they needed to years ago when the market did sour, when rates were rising, and now kind of what that looks like on their balance sheets, whether they're seeing significant losses, at least on paper, for those companies. And then on the other side, you have private credit, which Mike and I talked about earlier today, which if there is a worsening picture for the economy, this asset class has just grown tremendously in size and scale. So a lot of people have been warning about a deteriorating economy and what that means for the asset class, and therefore what it means for the publicly traded companies that hold a lot of exposure to this.
Yeah, Blue Owl, looking at it right now, down 4% today, 21.5% over a month. Les, appreciate you. Thank you. That's Leslie Picker. To Christina Partsinevelos now, who is watching the key stocks today as we inch towards this close. Christina.
Well, Scott, let's take a look at Novo Nordisk. The shares are sinking right now over 9% after the pharmaceutical giant released disappointing trial results for its developmental weight loss drug. This would be Cagrisema. It helped obese or overweight patients drop about 16% of their weight after 68 weeks compared to a previous estimate of 25%. So a difference there, and that's why you're seeing the stock down almost 10%. Meantime, Redfin shares soaring right now, so a bright spot after Rocket Companies said it would acquire the real estate listing platform in a $1.75 billion all-stock deal. The deal will connect Redfin's nearly 50 million monthly visitors with Rocket's suite of mortgage products, and that's why you can see Redfin shares up 69%, but Rocket, on the other hand, is down 15%. And the bell is about to ring, which is why the screen kept changing behind me, because they always do this show around this time.
Yeah, well, we have about 6 minutes to go. Yeah, Christina, thank you. That's Christina Partsinevelos. We're now in the closing bell market zone. Senior markets commentator Mike Santoli is still here to help us break down these crucial moments of the trading day. Tanea McKeel is watching the sell-off in Bitcoin and crypto, and Seema Modi is looking ahead to Oracle earnings out in overtime. Energy's green. As you said,
Sure.
Utilities are green. But that's about it, along with the VIX, which is up 20% at 28.
Yeah, under-owned and somewhat more stable areas of this market. Look, it's one of those things you can never quite put a pin in it in real time, but it did seem the selling intensity from like 2:30 Eastern into 3:30, that's the margin call window. It did seem to get a little bit frenzied, and you had a bit of a crescendo there. Does not mean we can't open down tomorrow and still have some reckoning to do. I will still say that the Treasury market, it's not exactly getting this massive safety bid. Yes, yields are down, but the 10-year is still above where it was a week ago. So you'd want to see some other things. It's not the fattest pitch you ever saw in your life, but you don't usually take a 9% decline in the S&P 500 over 3 weeks and say nothing's going on. But you can at least start to make the case that we're in the overshoot phase in the short term.
All right. I don't know whether, Bitcoin, Tanea, has decided it's done going down, but it's been volatile, and it was below 80 the last time I checked, 80K that is.
It might not be done going down, Scott. A brutal day for crypto prices. Bitcoin at a 3-month low, like you said, under 80,000, almost 30% off its record. And look at crypto stocks, down double digits. Coinbase pacing for its worst day since July 2022. And Coinbase and Robinhood both almost 50% off their 52-week high. A lot of bearishness for traders, but investors are quite used to these large pullbacks. Crypto, of course, not immune to these recession fears, and it's still without a clear crypto-specific catalyst. There isn't much on the immediate horizon to temper growing concerns about an economic slowdown. Many, of course, were hoping that Bitcoin reserve we got more details on last week might be that catalyst that brings more buy pressure into crypto. But as we discussed, a lot of disappointment on that front. So while the regulatory tailwinds for crypto are still intact, it's still got a good long-term story. Traders are refocusing on the monetary policy, which is what governed crypto prices for the most part before the election.
All
Scott?
right, Tanea, thank you very much for that report. Tanea McKeel now to Seema Modi with a look ahead to Oracle. Those earnings come in just a little bit in overtime.
And Scott, you remember it was late January when Oracle founder Larry Ellison, he stood by President Trump, SoftBank's Masatoshi Son, and OpenAI's Sam Altman to unveil this Stargate project, a massive data center project. Oracle shares initially shot up, but since then have waned and now are negative on the year. When the company reports tonight, investors will want more concrete answers on the return on investment for Stargate and the scale at which its cloud infrastructure business is growing. Above 50% is the running estimate, plus whether a deal with TikTok is in the cards. It's still the Chinese app's most important U.S. partner. That deadline is approaching, and we are watching shares Oracle sell off along with the broader tech sector, down about 4% ahead of that print, Scott.
Seema, thank you. See what happens. We'll look for you then. That's Seema Modi. Dollar. Been watching the dollar?
Yeah.
Because that's been on I don't know if you want to call it a free fall, but
Yeah,
it certainly
much.
has been weakening pretty substantially.
It did, yes. Although it has kind of halted that process a little bit here today. It does seem as if it's gaining a little bit of the benefit of whatever sort of safety bid is out there. Also, keep in mind we got nothing new on tariffs today. This has much more been about kind of the dam broke last week in terms of selling and in terms of the perception out there that economic pain comes before gain. But it's not necessarily about a lot of this global macro stuff. Equal weighted S&P, I'll point to it again, it's down 1.5% on the day. It's outperforming by well over a percentage point today. It's basically flat on the year. So you wanted a broadening market. This is sometimes what it looks like. which is
be careful
the
what you wish
one-third
for.
of the market that is 7 stocks, 7 expensive stocks with lots of like hopes and storylines embedded in them, have unwound and left the rest of the market to have to try to fend for itself.
A lot of barnacles hanging on to those big fish too,
No, for
right?
sure.
They're continuing to look pretty bad.
Exactly. And any way you slice it, I mean, if you have an outright recession call, then the market is not at the right price. It still has more to go down. But if it's not, then what we're talking about is a huge reset, taking the S&P back to mid-year levels of last year, really resetting sentiment as well. Institutional positioning is definitely more underweight versus the recent year's average. So all this stuff is kind of coming into place unless some kind of real inflection point has been reached in the underlying economy.
It's great points you make. It's the if, right? The uncertainty with the if. You don't want to be playing guess the earnings number, then guess the multiple. Right. And if you're going into a recession, the earnings number is probably too high and the multiple is too rich.
I mean, essentially,
as well.
that's kind of the game, but sometimes the market gives you the perception that a lot of it is very predictable, or at least the market's willing to pay up for perceived predictability. That's the story of Mag 7, over the last several years.
It's the game, but if the game changes faster than you expected it to, it's hard to adapt in a really short period of time. Mike, thanks for helping us get through here. The bell's going to ring in just a moment now, and it's going to ring out a lot of red. We'll be off the worst level, at least for the Dow, which was down more than 1,100 points at the low. It's still going to be down around 1,000. NASDAQ, the real pain point, is looking at a loss of more than 4%, more than 700 points down for the Dow. I'll send you to overtime now with John Ford.
That bell marks the end of regulation, mercifully maybe. PPL Corporation ringing the closing bell at the New York Stock Exchange. Silicon Labs doing the honors at the NASDAQ. Stocks closing off the lows, but it was another big sell-off to start the week, especially for big tech, with the NASDAQ tanking 4%, dragged down by Tesla, Palantir, Apple, and NVIDIA. The S&P 500 finishing lower by more than 2.5%. The Dow dropping just under 900 points. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Ford. Morgan Brennan is off today, and we're going to be all over this sell-off, the impact on your money throughout the show, what to do next. Evercore ISI's Julian Emanuel is going to join us with his thoughts on the sell-off, the risk of stagflation, and when to pull the trigger and buy equities during this pullback. Plus, much more on Tesla's tanking share price and a closer look at the dramatic pullback from record highs as the downturn in Elon Musk's company accelerates. And we're going to get a real-time read on tech when we get earnings from Oracle, which is trading at 6-month lows, along with Asana reporting as well. Now let's get straight to this sell-off, what to expect next from this volatile market. Joining us is Hannon & Walsh Asset Management President and CIO Kevin Mon, and Morgan Stanley Wealth Management Managing Director Dan Skelly. Guys, tell me something. Kevin, what happened? What happened? Give me a diagnosis here. Why the dramatic move today without a ton of news? And does the buying that started just before 3:15 tell you anything?
Yeah, I would start, John, by saying that March Madness is upon us. However, this year it started in the stock market as opposed to on the basketball courts, as investors continue to climb that proverbial wall of worry, whether it's fears over an economic slowdown, a potential recession, tariffs, overspending on AI. Check any box that you like. But this has led into a pullback and increased volatility. But to me, I see encouraging signs, particularly as it relates to market leadership. If you pull out consumer discretionary and information technology, the market's actually doing quite well year to date. I'm also seeing value outperform growth, international outperform U.S. markets. And to me, that's a reminder of the benefits of diversification. Don't overweight your portfolios in just 7 large cap technology stock. Look into other areas of the market to give you downside protection, but also allow you to take advantage of these changes in market leadership that we see developing.
Okay, maybe a little, salve. Balm for the disciplined. Dan, a lot of people gave cheerful 2025 S&P targets, but said there's going to be volatility in the first half. Well, here it is, right? Anything to change your target or assessment of the market versus weeks ago?
No, John, for us, the key takeaway is something we emphasized with you on this program back in January, which is that the market consensus in January around American exceptionalism had come a bit late. American exceptionalism has been an unstoppable force for many years, but it's run up against the immovable object of high valuation, policy uncertainty, and finally starting to see some catalysts outside of the U.S. So for us, the base case for a soft landing is still intact. We had always favored a broader market and more differentiated leadership in 25 than 24 and 23, and we're sticking to many of those key themes.
So, Kevin, what about sentiment?
Yes.
This is an expensive market by historical standards. Does a move like this shift the way maybe retail investors in particular feel about the market, and how long does it take for those feelings, right, for the cry to come out?
It certainly does. Coming off of 2 consecutive years of 25% plus performance, investors weren't braced for this type of volatility. They're expecting yet another double-digit year in terms of performance of the stock market this year, and that may not be realistic. But that doesn't mean you abandon the stock market together or abandon your longer-term financial goals and objectives. Rather, stay true to your risk tolerance. Stay invested in the markets. Give yourself some degree of downside protection. But don't try and time the market. We all know that's an exercise in futility. In fact, my biggest question right now, John, does the Fed come to the rescue if, in fact, the economic slowdown does intensify? Of course, they're caught right now between a rock and a hard place. High levels of inflation, and we'll learn more about this week, and a slowing economy. I think they cut rates 3 times this year by a total of 25 basis points, but we'll learn more next week.
I mean, rocking a hard place, Dan, or Scylla and Charybdis, you've got the increasingly tough nut of higher interest rates, and you've got the questions about what these tariffs are going to really mean in the longer term. I mean, Canada doesn't seem to be bowing down as somebody might have hoped, and maybe the prospect of a protracted trade war is weighing on this market, no?
Absolutely. And look, the market has correctly started to shift lower, and many Wall Street firms, including our own, are marking down some growth estimates. But let's keep in mind, John, that we are kind of myopically focused on the moment at all of the painful policy medicine that we're getting at the moment. But we still have policy candy yet to come later this year in the form of tax reform and potential benefits from deregulation. So we would agree with many of Kevin's points. We would be selectively adding today in terms of finding attractively valued financials, industrials, powering AI and AI infrastructure, selective ideas that could actually benefit if this market finds some stable footing towards the middle and end of this year.
Okay, Oracle results are out. We are going through them. We'll bring them to you as soon as we get them. Kevin, is there an increased importance, perhaps, in these Oracle results and guidance and Adobe this week, given that tech has been such a big part of the volatility? And these are 2 pretty sizable names reporting off the cycle of the other sizable names.
Yes, but isn't technology always important in the mindsets of investors who generally hold tech more than any other sector? What I'm encouraged by with Oracle, though, is that $100 billion Stargate initiative that they have around infrastructure with OpenAI. I like the stock because it pays an attractive dividend yield above 1%, and it's trading at a reasonable multiple, around 22 times forward-looking earnings. That seems like a good place right now. I believe earnings per share estimates are around $1.48. If they come in slightly above that and provide positive forward-looking guidance, that could be good for the stock. On the other hand, if it's contrary to that, you could see another reason for tech to correct a little bit further.
I like looking at both sides. On the other hand, Kevin, thanks. Dan, thank you as well. Well, let's talk more about the tech turmoil, and specifically Apple falling, let's see, more than 4.5% today as concerns grow about its AI strategy and maybe when its AI product fully rolls out. Steve Kovac's got more. Steve?
Yeah, John, with Apple shares down nearly 5%, that's making it its worst day since back in September 2022. By the way, that's also when we were talking about recession a lot. And it was a rough start to the year so far for Apple. It's down about 9% and down about 6% just for the month of March. Of course, we had Tariff Tuesday last week. That was a big catalyst. But there's another big catalyst today, that delay of the AI upgrade for Siri, which Apple said on Friday was not going to come until the coming year. And that's really damaging to the iPhone 16 bull case. Citi analysts this morning, they lowered their iPhone sales estimates and removed Series AI launch from its catalyst list for the stock. Meantime, we've seen iPhone 16 sales. They were slightly down year over year for the first quarter, that December holiday quarter, which was a big surprise. And Tim Cook telling us partial blame for that was because there was no AI in places like China for the iPhone. That led to the miss for Apple. In the meantime, you have competitors in artificial intelligence like OpenAI, Google, Amazon with that big new Alexa Plus service. They're shipping these new AI advancements all the time. And as for what Apple's working on, the next leg of its AI releases, we're not going to really know more until WWDC. That's that big developers conference we're expecting them to hold in June. And as for this big upgrade cycle, if you still believe that Apple Intelligence is going to start moving more iPhones, that's pushed out to the iPhone 17 this fall now, John.
All right. Steve, thank you. Well, Oracle earnings are out and ready. Seema Modi, how do they look?
With a slight miss for Oracle in the quarter, John, $1.47 adjusted. The estimate was for $1.49. Revenue coming at $14.1 billion. The street was looking for 14.3. Two specific categories within revenue, cloud infrastructure and services. Just a slight miss. Cloud infrastructure growing by 49% year over year. Very impressive, but the street was looking for 50 to 51%. I'll just read you some comments here from the CEO Safra Katz, who talks about how they have signed new cloud agreements with several world-leading technology companies. They mention OpenAI, xAI, Meta, NVIDIA, and AMD. And then founder and CTO Larry Ellison talks about data center growth. They're on schedule to double Oracle's data center capacity this calendar year. And they talk about how customer demand is at record levels. On the earnings call, John, we are going to want to see if the company provides more clarity on the return on investment of Stargate, that massive project it unveiled alongside SoftBank and OpenAI in late January. Since then, the stock has waned, and that's been a point of debate on Wall Street, is just how much money Oracle will be able to make from this specific project and how much it needs to spend on more graphic processing units. We're looking at shares currently trading flat but higher here in extended trade.
Yeah, back and forth. Oracle also doesn't give guidance in the release. They give that on the call. That's especially important today. I know you'll be all over that. Seema, thanks. Also want to mention Asana earnings are out. That stock is tanking here in overtime. We'll take a look at that shortly, perhaps. Well, Tesla, meantime, finishing at the bottom of the S&P 500. Worst session since 2020 as it faces protests across the country, competition abroad. As analysts from UBS and Redburn Atlantic reiterate sell ratings on the stock. Mike Santoli's got more on Tesla's rapid plunge. Mike?
Yeah, John, really about more than halving of the stock in the last few months. Yet it brings it back to what is something close to the average price for the last 5 years. And I like to look at this frame because in December of 2020 is when the Tesla went into the S&P 500 for the first time. That was this kind of wild run right there coming off that September 2020 correction. We've actually finished below the level at which it went into the S&P 500 for the first time. It was a bit over $231 per share. So it shows you, first of all, and I said it at the time, I never saw as much of wild anticipation of a stock going into the S&P, which happens multiple times a year to multiple stocks, as being so decisive. And obviously, it has not been great for long-time index holders of the S&P 500. Since that point, the overall S&P is up 50%. So clearly, that was front-loading a lot of good news at that point. Now, a related dynamic in this market is the absolute stampede out of one-time high momentum stocks. And of course, momentum is not just an adjective, it's also a strategy. It's sort of owning the stuff that's performed the best and sometimes shorting the worst performing. That's been a complete turnabout. This is an ETF that more or less tracks the long-only side of that strategy. And you see how steep that descent has been, especially compared to the low volatility parts of the market, kind of the tortoise strategy of the boring names in the index. And you see on a one-year basis, they're really just converging here. So the big question is whether that activity, that really forced repositioning out of the high momentum names, has largely run its course at this point. You can squint and say maybe that is part of what was going on late today.
Mike, there's Tesla, the company, and its results and what it actually makes. There's Tesla, the idea, the sorts of things that Elon Musk projects it's going to be about things like robots. And then there's Tesla, the security, right? There's Tesla, the stock. What does Tesla, the stock, mean at a moment like this? Because we talk about growth, we talk about momentum. It's unlike NVIDIA, it's unlike an asset like Bitcoin, but it's like some other things. So what else is moving perhaps in a way that Tesla is? Or what does this move in Tesla represent?
I think at the extremes, when it really starts to just fly and it has the entire kind of, the true believers really driving things higher, it becomes something like a meme stock, which is it's almost self-fulfilling, and Tesla goes up because Tesla goes up because that point of view that they're going to own some version of the future becomes ascendant. And we've essentially just round-tripped on that from the late last year in the race higher and unwound it. But if you want to just look at the car company and the actual earnings power right now, the estimates for 2026, I was looking at this earlier, at the beginning of last year were like $7 a share. They're now maybe like a little over half that at this point. So whatever you thought it was worth per dollar of earnings a while back, it should be worth, even if it's still worth the same thing, the stock should be cut in half. So the actual core business today is a relatively small percentage of the market cap, even after the current decline.
Mike Santoli, thank you for that perspective. We'll get some more for you a little bit later. I mentioned Asana earnings just moments ago. Seema Modi now got those numbers too. Seema?
Asana, this is a mid-cap software name reporting earnings break even. The street was looking for a loss of 1 cent. So it's a beat on its bottom line, John. And then if you look at revenue coming in line with street expectations at $188 million, why the stock may be down is first quarter earnings guidance lower than the street had anticipated. Also some changes in leadership. CEO and founder Dustin Moskowitz stepping down. He will transition to chair. A successor has yet to be named. The search will commence, the company says. We're looking at the stock down about 18% right now, John.
Yeah, that's a big move. Seema, thank you. Well, back now to the broader market. Stocks facing serious pressure to start the week as investors grow increasingly concerned about recession and stagflation possibilities. Let's bring in Julian Emanuel, Senior Managing Director at Evercore ISI. Julian, good to see you. You worried about stagflation?
It is definitely a concept. And in fact, if you think about it, the market has already begun to trade it. Typically, what you see in a stagflationary environment is an index level that averages, call it down 10 a year-over-year basis. Clearly, the last several weeks tell you that the market is thinking in those terms. But more importantly, what you see is leadership from the more defensive sectors, healthcare and consumer staples. Now, from our point of view, obviously the rhetoric that we've heard and the amount of change that's out there and sort of the dislocation has caused this activity. But when you step away, in our view, the hard economic data in no way matches the downturn in the soft economic data. Our econ team is still looking at 2% GDP growth for this year.
And your S&P target, correct me if I'm wrong here, is up about 20% from where we are right now on the S&P, no?
So it is. And look, when we came in to 2025, part of our thesis was this idea of 3 steps forward, 2 steps back in a very volatile environment. After 2 years of literally straight up stock market returns, year 3, despite our view that it's going to be positive, was something that was always going to be volatile, all the more so because of the policy mix that the new Trump administration has put forward. But again, when you think about what kills bull markets, we don't think there's a recession out there in the cards. We don't think valuations, if anything, have gone from very expensive, which is not necessarily in itself enough to kill the bull market, to just expensive on this pullback, which is actually better. The Fed is going to be cutting. And frankly, again, when we look at all of that, the bond vigilantes are telling you, if anything, yields are going to work in favor of stocks at this point.
Now, your bear case, though, is on the S&P is still lower from here, 5,200. What would it take? What would happen to start to convince you that things are trending toward your bear case?
That's really the stagflation scenario, John. So basically, a little more than down 10 in an environment where growth expectations would be, overtly marked down. And part of it, look, we have to be upfront of this. Part of it is the policy unfolding in the policy response. What we saw from the first trade war back in 2018 and 2019 was as the market sold off, policy, tariff rhetoric would ease. That had been the case until the last several days. Let's see what happens over the next week or two. There's a lot of data points in front of us.
Do you still expect that President Trump might ease up on this, or are you becoming convinced that he's serious about these tariffs, and perhaps that our allies who are facing these tariffs are serious about responding?
Well, and that's part of the dislocation is that essentially, whether it's tariffs or the whole dynamic around Ukraine and Russia, our allies are taking matters into their own hands. We have no doubt that the president is serious, but finding an off-ramp to a mutually, negotiable type dynamic is where we think this is headed, as opposed to anything that looks like Smoot-Hawley of the 1930s.
Okay, day by day, we'll figure it out. Julian Emanuel, thanks for helping us out.
Thank you.
After the break, ServiceNow CEO Bill McDermott joins us to talk about the sharp downturn for software stocks, how he's navigating the uncertainty, and the company's just announced multi-billion-dollar deal. And later, we'll talk much more about Tesla, now down more than 50% from its 52-week highs, with a look at the changing global sentiment toward the brand and its CEO. Be right back. Welcome back to Overtime. ServiceNow, a big mover today, down nearly 8% on a rough day for growth in AI stocks. I spoke with CEO Bill McDermott about why he's doubling down on AI with ServiceNow's biggest acquisition to date, MoveWorks, for $2.85 billion in cash and stock, and how he intends to challenge Salesforce in customer relationship management software.
Well, the MoveWorks acquisition, John, accelerates and extends ServiceNow's leadership in agentic AI, and we are redefining the AI world of work within the enterprise. So now think about every single employee being able to search all the data sources in these highly complex enterprises and get the same consumer grade experience as you and I get when we use ChatGPT on our living room couch on the weekend. So this is a total game changer, and it takes our fast-moving agentic AI business to a whole new level. We already own the middle and the back office of these enterprises. But if you take CRM, for example, a category we intend to be the market leader in for sure, think about sales and lead to loyalty, all customer prompts for salespeople so they can follow up on their account opportunities. It could be an upsell, it could be a cross-sell, it could be a renewal, it could be taking a pipeline and moving it into a sale. Think about customer service, providing on-the-spot customer information on order history and open support items. Think about finance, resolving common tasks like updating direct deposit, checking on payroll stubs, taking care of various timesheet entries for frontline workers.
ServiceNow's government business has been one of its growth engines. I asked whether the Department of Government Efficiency has changed the conversation in federal.
It has, and I think it's great. What DOGE is doing and what the leaders in our government are doing now is they want to give the American citizen, the taxpayer, a better service for their hard-earned capital. And I think getting efficiency, getting effective, getting productive is hugely important, and we're here to help. The other thing that you have to deal with, if you're going to have the same or even more work with a lot less people, you have to have the technology really fortify the strength of the people that you have. So now, instead of looking through reams of reports and putting people on 800 number hold for up to an hour and a half at a time, we just gave you an instantaneous agentic AI system to give every employee that's coming back to those federal, state, and local offices the answer to any question that they have to solve for a citizen.
Finally, I asked what impact tariffs will have on demand for ServiceNow software.
It'll increase the demand for our products and our services quite dramatically, because as supply chains change, as regulatory governance, compliance, taxation, all of these material shifts in the enterprise accommodate public policy, these systems today are so archaic. They've been there in many cases for more than a half a century. They do not have the capability to change on the fly. Today, I gave you a perfect example of extracting data from any source, reorienting in an automated workflow, a new business process led by agentic AI, working with the customer's data from any source so you can reconvene a natural language process on the fly. Think about an engineer writing a new piece of code to make sure that we can accommodate the new tariff laws.
McDermott telling me with the market turbulence, ServiceNow is controlling what it can, focusing on the customer, and as he put it, executing beautifully as it relates to the macro. Well, time now for a CNBC News update with Bertha Coombs. Bertha.
John, the U.S. and China have started talks for a potential summit in June, according to the Wall Street Journal, which says summit discussions are still in the early stages. The potential summit could help lead the way to formal trade talks as tensions mount over tariffs. Defense Secretary Pete Hegseth is expected to announce a plan to cut up to 10% of all general and flag or senior officers. Two U.S. officials tell NBC News as part of the plan, which hasn't been made public, most of the generals or admirals whose jobs are being cut or downgraded would be eligible for retirement. The move is part of an effort to cut costs at the Pentagon. The Department of Defense has yet to comment. And Pope Francis is no longer in imminent danger after spending nearly a month in a Rome hospital suffering from double pneumonia. But he will remain hospitalized for at least a few more days to receive treatment. The Vatican announced this afternoon that doctors for the 88-year-old pontiff lifted his prognosis after he responded well to drug treatments. We wish him well and a speedy recovery. Back over to you, Jim.
Indeed. Bertha Coombs, thank you. Well, we've got breaking news on Delta. Phil LeBeau has that. Phil.
John, take a look at shares of Delta, like all the airlines, down today, and this is going to add to some of the pressure post-market. The company warning about its Q1 results, cutting its earnings per share guidance. It was previously expecting to earn between 78 cents and $1 a share. Now expects to earn between 30 cents and 50 cents a share, with revenue growing 3 to 4% versus the previous guidance of growth of 7 to 9%. What's behind the lower guidance for the first quarter? Basically, they're seeing softness in domestic demand, the main cabin, and that deals with near-end consumer and corporate bookings. We're going to be talking with Delta CEO Ed Bastian in just a couple of minutes. We'll talk about this guidance and what he's seeing in the market right now. Is he concerned that this might last longer than the first quarter? We should point out, John, they are not changing their full year guidance at this point.
Okay, that's a big interview. We'll see you with that in just a few minutes. Also ahead, much more on the sell-off in big tech. We'll talk to an analyst about 2 Mag 7 names to consider after the pullback. And check out the action in Bitcoin, sinking below $80,000 with serious pain for crypto-related stocks like Strategy and Coinbase. We'll be right back.
Insurance.
Welcome back. Shares of Delta falling in overtime. News breaking moments ago that the airline is lowering its first quarter guidance after seeing softness in domestic demand. Joining us now on set is Delta Air CEO Ed Bastian and our own Phil LeBeau. Phil.
John, thank you very much. Ed, thank you for being here. It's good to see you.
Good to see you, Bill.
I think the main question that I think a lot of people have is softness in domestic demand. This sounds pretty generic. What does that mean? Where are you actually seeing the weakness?
Well, we'll be here tomorrow in New York at an investor conference, so we'll be presenting and get into a lot more detail. In fact, I think I'll be speaking at 7:30 in the morning, so I'll have a chance to get through that. But at a high level, first, the first quarter is always the seasonally most difficult quarter of the year for our industry, and historically somewhat tough to project. You couple that with the fact that we entered the quarter with high growth expectations. We finished the year strong. We were up, in the fourth quarter, a meaningful amount. We anticipated an 8% growth rate in terms of top line. We're going to come in on a 4% growth rate. So it's not going backwards, but it's not growing as fast as we were anticipating. We know that GDP is one of the most important factors that our industry is correlated to. We saw in February a pretty significant shift in GDP sentiment and the output and the confidence signals that we monitor. Consumer confidence is kind of coming down a little bit, as we all know. That's why the market is in the challenge it is. And as a result of that, we saw companies start to pull back in terms of corporate spending, started to stall. Consumer spending started to stall, largely domestic, largely in the close in. But it was also exacerbated as the uncertainty that's out there. And consumers in a discretionary business do not like uncertainty. And while we do believe this will be a period of time that we pass through, it is also something that we need to understand and get to calmer waters.
Let's split these two from the consumer and the corporate CEO. And I want to talk first about corporate CEOs. You were just with a number of CEOs this last weekend. Who are the industries, or what are the industries, that you're noticing the biggest pullback in demand right now in terms of bookings? And what are they saying about their concern about the macro environment and the uncertainty that's out there right now because the policies in Washington? We know in a broad sense what the president wants to do, but we're a long ways from seeing these things put in place.
Yeah, they'd be the industries you'd anticipate. It'd be aerospace and defense. It would be autos. It would be the media, entertainment, and tech space, where there are places where people just aren't quite sure what's going to happen. Companies are pulling back. But we also, at the same time, it's not just corporates. At the same time, we also had the impact of the aircraft accident that American experienced at the end of January. And then we had our own Toronto incident that was also happening all around the same time. So these events somewhat exacerbated the impact on us. So it's not just corporate and consumer. It was also a question about safety in our industry.
Sure.
And we do know it's safe to fly, and we do see that starting to dissipate. All these factors had a compounding effect that led to the size of the impact, which we're talking about is about a $500 million impact in the quarter.
Given the fact that government spending is being slashed in Washington, is that impacting your bookings right now?
I'd say to a modest degree. The government contractors, the aerospace and defense business, certainly the employees that feel threatened as to whether they're going to have a job are not out there spending money traveling. That said, we're looking at this as the weakest time season of the year. We're starting to head into spring. We're starting to head into the summer. I think we'll have a much better handle on this. I think a lot of the impact we saw in the quarter is transitory, that we'll push through. The other thing that we had is our inventory systems were booked and anticipating that we would start to see a strong close-in demand, higher pricing yield that never showed. So we had to recalibrate our systems all during the quarter. All these factors we're working through. So of the $500 million, I feel optimistic that at least half of that is transitory as we start to go into the second quarter. And then you look at the other side of it, oil prices are also down by $10 a barrel.
Which certainly benefits you.
Which is why we're not changing our full-year forecast.
And across the industry, there had been this reliance, I think, on premium, on, beyond main cabin. Consumers were spending more. Has that changed also with what you're seeing in this trend?
No, there are several green shoots here. Premium is held up and continues, it's on plan. The loyalty base, the co-brand spending that we have with American Express. I was with Mr. Squiri over the weekend. That's running at a double-digit clip for us in the first and second month of the year. That's held up. We see international, particularly transatlantic and trans-Pacific, holding up, and our unit revenues growing into through the winter and into the spring and summer. So we really do believe this is a domestic issue. We'll find out, of course, as the weeks go and policies start to get decided upon. But I think we have plenty of green shoots out there to give us some room of optimism that we're going to be able to continue moving through this period of time. And we'll still be profitable this quarter. Our profit level is going to be consistent with where it was a year ago. So even with all these challenges in the quarter we just talked about, we're still delivering the same level of profit. So it's not growing, but it hasn't gone backwards.
And what about that biz leisure trend of people extending business trips and maybe bringing their families along? Does that continue, or are people pulling back?
I think, John, that's overstated, candidly. I think that's dissipated over the last couple of years, the return to offices mandates that you have. People have learned to travel in different ways. And yes, you have hybrid travel is a bigger part than ever, but not nearly as much as it was in the early years of COVID.
Ed, you've been through more than a few economic cycles in your career. You hear a lot of people right now talking about potentially a recession in this country later this year. Do you get that feeling? You've seen this. You know what a recession feels like, and you see it in terms of bookings. Do you get the feeling that we potentially are headed towards a recession?
I don't feel it. It just said we're growing 4%, not 8%. If I was a recession, we'd be down 10%, right? So you don't see it. I think there's a lot of uncertainty. But I still think there's cautious optimism that as the uncertainty starts to clear, then businesses are going to be ready and poised to start to grow.
All right. Ed Bastian, CEO of Delta, thank you, and our own Phil LeBeau as well. I know you're going to unpack all of that at the investment conference tomorrow, but thanks for doing it first with us here on CNBC. Well, high bond yields have been a bright spot in the market this year. Up next, Mike Santoli looks at why corporate bond investors have been playing it cool even as stocks sell off. And later, as Tesla shares post the biggest loss since September 2020, we look at the very different views consumers in the U.S. and China have towards CEO Elon Musk. We'll be right back.
consultations.
Welcome back. Stocks selling off big today, but one part of the market still pretty chill. Mike Santoli's back to explain. Mike?
Yeah, John, the credit markets in general, though they did start to notice the weakness in equities, have remained relatively calm. We'll take a look at that in a second. But look at the publicly traded private equity and private credit stocks. This is emblematic of the entire group. That's Apollo, KKR, Blackstone. This is Blue Owl. And for all the reasons that investors were optimistic about this industry in the latter part of last year, look, it's a leveraged play on strong equity values, more deregulation, a lot of IPOs, a lot of M&A, just a general sense of capital markets confidence. That's what these guys capitalize on, and that's come in reverse. It almost looks like kind of Newtonian mechanics, like equal and opposite reaction back down toward the flat line on a one-year basis. However, the actual pure reading on high yield credit spreads, therefore the risk compensation that people are demanding on the lower quality loans, it really doesn't look like much, right? Higher spread means more demanded compensation, meaning that's when the markets are very unsettled. Down, it's these lows, it's very confident. Now, this is like day-old data, so it has perked up a little bit since then. It's kind of got up out of this very low range, but it is still suggesting that really not a lot of macro stress has made its way into the public credit markets. One reason some think that might be is that private credit is taking on a lot more of the riskier loans that don't make their way into the public high-yield index, John.
So the private credit piece of this, we've talked a lot about this over the past few months to the point where it was making me a little uneasy how much everybody seemed to be talking about private credit. Sure. Is that reflected, what's happening to private credit in that first chart that you showed?
To a degree, yes. I mean, Blue Owl, for example, is very active in that area. And it's not so much that I think the market is saying all those loans are going to go bad and we're going to have a recession and there's going to be massive default crisis and things like that. But they're just saying it's just not as ripe an opportunity set as we thought it was going to be. Clearly, there hasn't been an IPO boom. Going to be tough for private equity to make those exits. And then private credit, I mean, arguably, while they're getting very, very high yields for the loans that they make, in a downturn, those companies are not going to have it particularly easy. If you redefine private credit, at least in part, as corporate subprime, maybe people would feel a little bit less happy about what that means.
Yeah, it doesn't sound as good. Mike Santoli, thank you. Well, Tesla having its worst day in nearly 5 years, and Elon Musk's political actions could be a headwind for the stock. But the way he's viewed in China, much different. Details straight ahead. And later, 2 mega-cap tech names to consider. Talk about that with an analyst where he's looking to buy the dips in the tech wreck when overtime comes right back.